If you've been watching XRP, you just saw the headlines. Ripple gets regulatory approval. XRP green light in Europe. This changes everything for crypto payments. And look, I get the excitement. The XRP community has been through years of regulatory uncertainty and legal battles with the SEC. But before we go full moon mode, let's talk about what actually happened, what it means for XRP the token versus Ripple the company, and most importantly, what comes next that you can actually track. Because most XRP coverage right now is either pure hopium, people claiming this means XRP is going to $10 tomorrow, or pure FUD from people betting against it. What I want to do is cut through both extremes and give you the actual story, the verifiable milestones, the infrastructure that's shipping, and the 3 specific things you should be watching over the next 90 days if you want to separate signal from noise. Alright, so here's what happened. Ripple Labs received full electronic money institution approval from Luxembourg's financial regulator, the CSSF. This is a real regulatory license on the public record. Now, what does that mean? An EMI license lets Ripple operate payment services and issue electronic money across the European Union. Think of it as distribution permission. They can now scale payments infrastructure, open corridors, onboard institutions, and facilitate cross-border transactions under a regulatory framework that covers all 27 EU member states. That's a big deal because they have explicit permission to build and scale payment infrastructure across one of the world's largest economic zones. But here's what it's not. This is not XRP is officially adopted by every bank in Europe starting tomorrow. This is not Ripple just became the new SWIFT. This is not XRP price guaranteed to 10x from here. What it is? It's regulatory clearance to operate at scale. And that matters. It removes uncertainty and gives institutional partners confidence. But the impact on XRP the token is conditional, and that's the part most people skip. Here's the uncomfortable truth that a lot of XRP channels won't tell you, because they're more interested in keeping you hyped than keeping you informed. Ripple doing well does not automatically mean XRP goes up. I know that's not what people want to hear, but it's essential to understand if you want to make smart decisions with your money. Ripple is a company. XRP is a token. They're related. Ripple created XRP. Ripple holds a significant amount of XRP, and Ripple builds products that can use XRP, but they're not the same thing. And this distinction matters more than almost anything else when you're evaluating news about Ripple. Here's an example. Ripple could sign 50 new payment partnerships tomorrow. They could expand into a dozen countries. They could process billions in transaction volume through their payment network. And if those flows don't use XRP as the bridge asset, the direct impact on XRP price is minimal. You might see sentiment-driven pumps when headlines drop because traders get excited and start buying. But sustained price appreciation requires sustained utility demand. Price speculation can take you up for a few days or weeks, but if there's no underlying demand for the token itself, the price eventually comes back down. That's just how markets work. So when we talk about this EMI approval, the question isn't just, is this good for Ripple? The answer to that is obviously yes. The question is, does this create pathways where XRP gets used more? And here's where it gets interesting, and where we need to pay very close attention to what happens next. If Ripple's payment flows leverage XRP as the bridge currency in its on-demand liquidity product, which they've been building and refining for years, then yes, more corridors, more volume, more institutions using the rails can translate into increased XRP demand. Here's how that would work. When a bank or payment provider wants to send money from euros to, say, Mexican pesos, traditionally they'd need to hold pre-funded accounts in both currencies. That ties up capital. It's inefficient. On-demand liquidity uses XRP as the bridge. The sender converts euros to XRP, transfers the XRP instantly, and the recipient converts XRP to pesos. The whole thing takes seconds instead of days, and no capital is tied up sitting in Nostro accounts. But here's the key. For that to work, there needs to be XRP liquidity on both sides of the transaction. That means more transactions create more demand for XRP liquidity, which can support price over time. That's utility-driven demand. That's the kind of thing that creates sustained price appreciation because it's based on actual usage, not just speculation. But, and this is the big but, if Ripple's EU expansion happens mostly through RippleNet, which is their messaging layer that connects banks but doesn't require XRP, or if institutions choose fiat-to-fiat settlement instead of crypto bridging because they're not comfortable with the volatility or regulatory uncertainty around holding crypto, then the license is bullish for Ripple as a business, but the XRP impact is indirect. You'd be betting on Ripple's success eventually benefits XRP holders, rather than this approval directly drives XRP usage. And look, I'm not saying the EMI approval doesn't matter for XRP. I think it absolutely does. Regulatory clarity makes institutions more likely to try crypto-based solutions. It removes one of the biggest objections banks have had to using XRP. But the link is not automatic. It's pathway dependent. And that's why, when you're evaluating news like this, you need to ask yourself, does this expand the infrastructure where XRP can be used, or does it just expand Ripple's business footprint? In this case, I'd argue it does both. But the XRP upside requires follow-through. We need to see actual corridor launches that specify they're using XRP. We need to see actual volume flowing through ODL. We need to see actual institutional adoption of XRP-based settlement, not just pilot programs or proof of concepts that never go anywhere. That's what we're tracking. Not just the headline, but what happens after the headline. Because that's where the real story is. And speaking of tracking what actually matters, if you want to go deeper on how to evaluate projects, read on-chain data, and build a strategy that isn't just based on headlines, I've put together a full course that walks you through exactly that. Links in the description. No fluff, just the frameworks I use. All right, back to the video. So why is this Luxembourg approval a big deal, even if the XRP impact is conditional? Because it's distribution permission in a market that's been moving faster than the US on crypto clarity, and that matters more than most people realize. Think about it. While Washington is still gridlocked on market structure bills, fighting over whether stablecoins should pay interest, and watching the SEC and CFTC argue about which agency gets to regulate what, Europe has been stacking up actual regulatory frameworks. MiCA, Markets in Crypto Assets, went live. That's comprehensive crypto regulation that covers everything from stablecoins to exchanges to custody providers. EMI licenses are being granted to payment companies that meet specific standards. Payment firms are getting clear pathways to operate. There's an actual playbook for how to build crypto businesses in Europe without constantly looking over your shoulder wondering if regulators are going to shut you down. And Ripple just got one of these licenses. That's not symbolic, that's strategic. This isn't some backwater jurisdiction where you get a license just by filling out a form. Luxembourg is the EU's financial services hub. It's where major banks, payment processors, and fintech companies set up shop when they want to operate across Europe. There's a reason PayPal, Amazon Pay, and dozens of other major financial services companies have entities in Luxembourg. It's because the regulatory framework there is respected, the infrastructure is solid, and having a license there gives you passporting rights across the entire EU. Getting a license there is not just about Luxembourg. It's about having legitimate, regulated access to 450 million people across 27 countries. Now, with this approval, Ripple can expand payment corridors into EU markets with regulatory cover. They can walk into meetings with European financial institutions that were sitting on the sidelines waiting for clarity and say, "We're fully licensed, we're compliant. You can work with us without regulatory risk." That changes conversations. That opens doors. They can scale their infrastructure in a region that's actually welcoming innovation instead of litigating it. And here's the kicker that I think is the biggest story here. When rules lag at home, the winners are the firms stacking licenses abroad. The US is still Ripple's biggest long-term opportunity, no question. The American financial system is the deepest, most liquid, most influential in the world. But if American policy stays stuck in neutral, while Europe, the UK, Singapore, and the UAE roll out clear frameworks and actively court crypto companies, you're going to see more crypto infrastructure, more institutional adoption, more innovation, and more liquidity flowing into those markets first. And by the time the US gets its act together, the infrastructure will already be built elsewhere, and American companies will be playing catch-up. Ripple just locked in access to 27 countries in one shot, and they did it while their competitors are still trying to figure out the regulatory landscape. So yeah, the green light is real. It's not hype. But the question is, what happens next? Because approval is just the starting line, not the finish line. All right, let's zoom out from Ripple the company for a second and talk about the XRP ledger itself. Because there's a second green light happening that's getting way less attention, and it's arguably just as important for the long-term value proposition of XRP. XRPL version 3.1.0 just shipped, and buried in that release are two major infrastructure upgrades: single asset vaults and a native lending protocol. Now, if you're not deep in the weeds of XRPL development, you might be thinking, cool, tech stuff, why should I care? I'm here for price action, not GitHub commits. But here's why this matters more than most people realize. Institutions don't adopt blockchains because of partnerships or marketing. They adopt blockchains because of infrastructure. They need to know that the technology can handle real-world use cases at scale, that it's secure, that it's been battle-tested, and that it has the features they need to build products on top of it. And what XRPL just shipped is the kind of infrastructure that expands what can be built on the ledger, which is exactly what institutions care about when they're evaluating whether to deploy capital, build products, or integrate a chain into their tech stack. Let's break down what these upgrades actually do and why they matter. Single asset vaults let you lock up specific tokens on-chain with programmable release conditions. Think of it like a smart contract escrow, but native to the ledger instead of being a separate layer on top. Why does that matter? Because it enables use cases like scheduled payments. Imagine an employment contract where salary is automatically released every 2 weeks without anyone having to manually process it. Or trustless vesting. A startup can issue tokens to employees that unlock over time, and no one has to trust the company to follow through because the release schedule is programmed into the ledger. Or collateral management. You can lock assets as collateral for a loan, and they're automatically released when the loan is repaid. Or automated treasury operations. A DAO or company can program when and how funds are released based on specific conditions. All things that financial institutions and sophisticated users need if they're going to use a blockchain for real-world settlement and not just speculation. These aren't theoretical use cases. These are things that every modern financial system needs, and XRPL just made them native to the protocol. The lending protocol is even bigger. It's a native on-ledger framework for collateralized lending. You can deposit assets, borrow against them, and earn yield, all without relying on third-party smart contract risk or external DeFi platforms that might have vulnerabilities or might get exploited. Now, here's the critical part. The lending amendment just entered validator voting. That means the network's validators, the nodes that secure the network and process transactions, are deciding whether to activate it. If it passes, and it looks like it probably will based on early signaling, XRPL becomes one of the few blockchains with a native, protocol-level lending market. Not a DeFi app bolted on top, but part of the base layer of the protocol itself. And that's a fundamentally different value proposition from what most other chains offer. Most DeFi happens on smart contract platforms like Ethereum or Solana, where you're trusting the code of a specific protocol. Someone wrote a smart contract for a lending platform, deployed it, and now you're trusting that the code doesn't have bugs, that the economic design is sound, that the Oracle feeds are accurate, and that the developers didn't leave a back door. And we've seen what happens when those assumptions break. Billions of dollars have been lost in DeFi exploits. When lending is native to the ledger, it's secured by the same consensus mechanism that secures the entire chain. It's not a separate smart contract that someone deployed, it's part of the core protocol. That means lower smart contract risk because there's no separate contract to exploit. Tighter integration with the rest of the ledger, so everything works together seamlessly. More composability with other XRPL features, which means developers can build more sophisticated products on top of it. For institutions, that's compelling because they care about security and reliability above almost everything else. For retail users, it means you can actually earn yield on XRP holdings without wrapping tokens, bridging to another chain, or trusting a third-party protocol. You just deposit to the native lending protocol, and you're done. But, and this is important, and I want to be honest about the risks here, it also introduces new attack surface. Lending protocols are complex. They involve collateral ratios, liquidation mechanisms, interest rate calculations, Oracle dependencies. They've been exploited on every chain that's deployed them, from Ethereum to Solana to BSC. We've seen flash loan attacks, Oracle manipulations, liquidation cascades that spiraled out of control. So while this is bullish for XRPL's functionality and expands what's possible on the ledger, it's also something to watch closely as it rolls out. The XRPL developers are experienced and the protocol has a good security track record. But any new feature introduces risk. The point is, XRPL is evolving from fast payments ledger to programmable financial infrastructure. It's not just about sending money quickly anymore. It's about building complex financial products, creating lending markets, enabling DeFi applications, supporting NFTs and tokenization. And that's the kind of thing that expands the universe of what can be built on top of it, which expands the universe of who might want to hold or use XRP. But again, infrastructure alone doesn't drive price. You need developers building on it. You need institutions deploying on it. You need actual economic activity flowing through these new features. That's what we're tracking next. All right, let's talk about the elephant in the room, the United States. Because while Ripple's getting approvals in Europe and XRPL's shipping infrastructure upgrades, the US is still stuck in crypto policy purgatory. And if you're holding XRP or any crypto, you need to understand why this matters and why it's taking so long. Right now, Washington is deadlocked on the Clarity Act, the big bipartisan crypto bill that's supposed to define which digital assets are securities, which are commodities, and who regulates what. This was supposed to be the bill that finally gave the crypto industry the clarity it's been begging for. Democrats and Republicans actually agree that we need clearer rules. Industry groups have been lobbying for it. Even some regulators have said publicly that the current framework is inadequate. So you'd think this would be easy, right? Just pass the bill and move on. Sounds straightforward, right? It's not even close. The holdup isn't even about Bitcoin or Ethereum anymore. It's not about whether crypto is securities or commodities. It's not about which agency should regulate exchanges. Those debates have largely been settled. The real holdup is about stablecoins. Specifically, it's about whether stablecoin issuers should be allowed to pay interest on customer balances. Here's the breakdown. Some lawmakers want stablecoins to function like money market funds, where users earn yield on their holdings. That makes sense from a consumer perspective. If you're holding $10,000 in stablecoins, why shouldn't you earn interest on it like you would in a savings account? Others argue that paying interest turns stablecoins into securities or bank deposits under existing law, which means they'd fall under different regulatory frameworks and potentially face stricter reserve requirements, capital requirements, and oversight. Banks argue that if stablecoin issuers can pay interest without being regulated like banks, that creates an unfair competitive advantage. Consumer advocates worry about systemic risk if stablecoin issuers aren't subject to the same prudential standards as banks. And until they resolve that fundamental question, the whole bill is stalled. Not because people disagree on crypto regulation, but because the stablecoin interest question touches on banking law, securities law, monetary policy, and financial stability all at once. Now you might be thinking, what does that have to do with XRP? I'm not here for a civics lesson. Everything. It has everything to do with XRP and every other crypto asset. Because as long as the US doesn't have clear market structure rules, American institutions are going to be cautious about deploying crypto infrastructure at scale. They're not going to build payment rails on XRP if they don't know whether the SEC is going to call it a security in 6 months and require them to register as a broker-dealer. They're not going to custody large amounts of digital assets if the regulatory framework could shift underneath them and suddenly expose them to liability. They're not going to launch crypto products for their customers if they might get sued or fined later. Institutions hate uncertainty. They'll accept risk if they understand it and can price it, but they won't accept uncertainty that could fundamentally change their business model. So what happens? They wait. Or they go offshore. And that's exactly what's happening right now. While the US argues over stablecoin interest, Ripple is stacking licenses in Europe. While American regulators fight over jurisdiction, the UAE and Singapore are onboarding crypto firms with clear rules and fast approvals. While Congress debates, Hong Kong is positioning itself as a crypto hub. The world is moving forward, and the US is standing still. The US is still the biggest opportunity long-term, no question. American capital markets are deeper, more liquid, and more influential than anywhere else. The dollar is still the global reserve currency. Wall Street is still Wall Street. But if policy stays stuck in neutral for another year, you're going to see more infrastructure, more partnerships, more institutional adoption, more innovation happening outside the US first. And Ripple's EMI approval is proof of that trend. They're not waiting for the US to figure it out. They're building where the path is clear. So when you're evaluating XRP's outlook, don't just watch the price chart. Watch where the regulatory momentum is actually moving, because that's where the infrastructure gets built. And infrastructure is what drives sustained adoption, which drives sustained demand, which drives sustained price appreciation. Speculation can pump a price, but only infrastructure can sustain it. All right, so we've covered what happened, why it matters, and what the broader context looks like. Now let's get tactical. If you're trying to figure out whether this green light actually translates into XRP upside, here are the 3 specific things you should be tracking over the next 90 days. These aren't vibes. These aren't "my sources say" rumors from anonymous Twitter accounts. These are hard, verifiable updates that will tell you whether momentum is building or stalling. First, follow-up corridor launches tied to the EU license. Ripple has the license. Now we need to see them use it. What you're watching for: announcements of new payment corridors in Europe that explicitly use on-demand liquidity, ODL, Ripple's XRP-powered settlement product. Not just Ripple partners with European bank. Not just RippleNet expands to new country. We need corridor launches that specify XRP as being used for liquidity. That's the difference between Ripple growing as a company and XRP growing as a utility token. If Ripple starts lighting up euro to peso, euro to baht, or euro to naira corridors using XRP as the bridge, that's real utility expansion. That's actual transaction volume that requires XRP liquidity. That's the kind of thing that can support sustained price appreciation because it creates actual demand for the token, not just speculation about future demand. If they announce partnerships but they're all RippleNet without ODL, that's still business growth for Ripple, but the XRP impact is indirect. It might move the price on sentiment, but it won't sustain it. So watch the corridor announcements, and watch the language they use. If they say, powered by XRP or using on-demand liquidity, that's the signal. That's what matters. Second, XRPL validator vote progress on the lending amendment. The lending protocol is in validator voting right now. That means the network's validators are deciding whether to activate it on the main net. What you're watching for. Whether the amendment reaches the 80% validator approval threshold needed to go live. And if it does, how quickly developers start building lending products on top of it. If the lending amendment passes and you start seeing DeFi protocols, institutional custody providers, or yield platforms integrate XRPL lending, that's infrastructure momentum. It means the ledger is expanding its use case beyond payments. It means developers see opportunity there. It means the ecosystem is growing. If it fails to reach consensus, or if it passes but no one builds on it, that tells you adoption is lagging. That tells you there's a disconnect between what the protocol can do and what people actually want to build. You can track the voting progress on XRPL validators' public data. Watch for announcements from XRPL labs and major validators about when the vote closes. This is public information. You don't need insider access. Third, U.S. Clarity Act negotiations, specifically the stablecoin rewards clause. This one's less XRP specific, but it's the macro backdrop that affects everything. What you're watching for. Whether Congress resolves the stablecoin interest debate and moves the Clarity Act forward, or whether it stays deadlocked through the midterms. If the bill passes and crypto gets clear market structure rules, that opens the door for U.S. institutions to start deploying at scale. And if Ripple's already built out EU infrastructure by then, they'll be in pole position to expand back into the U.S. with regulatory clarity on both sides. That's a huge competitive advantage. If the bill stays stalled, expect more of the same. Slow U.S. adoption, continued offshore expansion, and regulatory arbitrage driving where crypto infrastructure gets built. That's not necessarily bad for XRP. It might actually be good if Ripple keeps stacking international wins, but it matters for understanding where the momentum is. You can follow this on congress.gov under HR 4763, the Clarity for Payment Stablecoins Act. Watch for committee hearings, amendments, and floor votes. This is all public information. Those are your three trackers: corridor launches, lending vote, Clarity Act progress. If all three move forward, XRP's got a real structural tailwind. If they stall, the green light might just be a headline that fades into the next news cycle. So let's bring it home. XRP just got a green light. Ripple secured an EMI license in Luxembourg, which unlocks payment expansion across the entire EU. XRPL shipped infrastructure upgrades that expand what can be built on the ledger. And the US is still figuring out its regulatory framework while the rest of the world moves forward. Does this change everything? Not overnight, but it changes the trajectory. Ripple now has distribution permission in a major economic zone. XRPL now has the infrastructure to support more complex financial products. And the regulatory landscape is shifting in a way that rewards firms who build outside the US, while American policy stays stuck. But here's the key. Infrastructure is not adoption. A license is not usage. A shipped feature is not transaction volume. What matters next is follow-through. Corridor launches, developer activity, institutional onboarding, actual XRP flowing through actual payment rails, not just press releases and partnership announcements. So if you're holding XRP, or if you're thinking about it, don't get caught up in the hype cycle. Track the fundamentals. Watch the three things we just covered. And remember, Ripple doing well is not the same as XRP going up, unless the pads they're building actually require the token. That's the difference between speculation and investment. And that's what separates the people who get wrecked in crypto from the people who actually build wealth. All right, that's the breakdown. If you want to go deeper on how to evaluate crypto projects, read on-chain metrics, and build a strategy that isn't just based on YouTube hype, I've put together a full course that walks through the exact frameworks I use. It covers everything from fundamental analysis to risk management to spotting real utility versus vaporware. Links in the description. No BS, just the tools you need to make better decisions. And if you found this helpful, drop a like, hit subscribe, and let me know in the comments what you're tracking for XRP over the next few months. I read every single one. Thanks for watching. I'll see you in the next one.